All right, stocks started the week off. I get started off the past so many weeks with a nice little rally to the upside, just like pretty much like last week. In fact, this video is very similar to last Monday's video, where again, like last Monday, I wasn't too sold on the rally. I'm not too sold on this rally either. It might last a little longer this time, but I don't think it will be trend changing. I think we'll ultimately stay in this intermediate decline, and we'll talk about why. I'll show you all the signals. That still kind of show that we haven't really exhausted the intermediate decline like you typically do. There's some pretty bad breadth and that we don't typically see, but and we've obviously had clusters on the NASDAQ 100, so there are some oversold signs, but it still hasn't been nearly as it hasn't been the same type of sentiment shift that we've seen previously, and it's usually that's what it takes is for sentiment, to finally shift to the downside for the contrarian, trade to work out for the bounce, the buy, the dip back up to the upside. So I'll show you kind of what I'm talking about there and what's really driving today's. I think a lot of it is oversold technical bounces, and I'll show you why they are, especially from a sector rotation standpoint. And then our trade idea of the day is a stock that's been doing outstanding. Not in the technology area, and you wonder if it's starting to bleed, and you're starting to see some weakness in that stock in that area of the market. So we'll talk about how to trade that, similar to what we've done here a lot recently. So we'll do another one today. So let's go ahead and get started. Today is Monday, August the 21st, 2023. This is the market outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. We almost got to 100. We're getting closer. We're getting closer and closer to 100. So if you can, thank you again to those of you who do that day in and day out. A lot of you do this for my videos and Brandon's. We really appreciate it. Those who don't, you can like it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So like last Monday, we started off the week, and really, I think it's been this looks like it was, this was a Monday right there too, that we rallied up, and then we're down the rest of that week, and then we rallied up here, down the rest of that week, and now we rallied. So kind of it's been, in fact, you could say, looks like this was a Monday there too. So there's a Monday. We've been up at least the 1, 2, 3, 4, 5 Mondays in a row. In fact, interestingly enough, these last 3 weeks, every other day was down. So we were down, up there, though down off the highs and down from the open, down, and then down. So it's the Mondays have been the only good days for the past 3 weeks since this whole kind of intermediate decline started here, really at the end of the month when the calendar changed from July to August. You notice the short-term sentiment is back up. Again, not it's higher than it was last Monday. Momentum line's about the same. The near-term line's higher. It's about as high as it got the prior Monday, the momentum line, then the near-term line got there the next day. So we'll see if this third time's the charm, that the momentum and near-term line is able to get through, and if we're able to maintain bullishness here. I actually think we will. I think the near-term line will make it into bullish territory here. The question will be, of course, how far, and whether or not, if we can get a good strong move to get the momentum line up above the 90th percentile, then we have a good chance of the near-term line getting above the 80th percentile and staying there. That's the ideal scenario. But if not, then again, we're going to continue to. The intermediate line's in the lower reversal zone, so we will now be susceptible to oversold clusters now that the intermediate line is down there, And the intermediate line doesn't typically stay down. In a bullish market, the intermediate line won't stay below 20 for more than a few days, a week at the most. And then you get a good, usually that when you're down there, that next short-term sentiment run is strong, gets you out of it. Boom, boom, gets you out of it. That's when you're bullish. So that's really what we need to see. We need to see this near-term rally really break us out and get that intermediate line, which is still pointed lower. So it's not going to get out above the 20th percentile for a few days. You are still more than 2% below, though you're not 2.5 anymore. You are still more than 2% below the 30-day moving average, so we're not going to get 3 green arrows anytime soon. You'll see in a second. Market sentiment's falling, and it's below the 80th percentile now, so watch for the intermediate line when it does rally to whether it crosses back above that or not. Because now, when it's above 80, it doesn't matter if it's going up and down. But when it's below 80, it will act as a ceiling for the intermediate line. So something we want to keep an eye on there for the S&P 500. The Nasdaq, of course, was the most bullish today with Tesla and Nvidia doing so well, coming off of what was almost a triple cluster on Friday. We avoided it barely, and the short-term sentiment did get to bullish territory here. So still not quite, above the 90th percentile for the momentum line, or above the 80th for the near-term line. But barring, if we can get a good move tomorrow, then we can get there, right? We can make that move up higher. Very bearish short-term sentiment for the Dow. So the Dow, which has been kind of holding on, right? It hasn't turned dark pink shading, and in fact, the intermediate line just barely turned below the 50th percentile today. So you finally have the dark pink shading, but you're still not below, got the red line. The moving average hasn't turned lower yet. Short-term sentiment got out of the reversal zone, but still in bearish territory, so still very low. So you can see a lot more bearish on the Dow. And then your Russell 2000, the intermediate, again, short-term sentiment was pretty subdued. You were down today on the Russell as well. You are way below. You're the furthest below 30-day moving average. The Russell's been really bearish during this decline, probably more bearish than any of the other indexes. And the intermediate line now which had been so bullish, has gone way down here, is almost in the reversal zone, and then market sentiment, just like on the S&P, is falling here, and will act as a ceiling on any run to the upside for the intermediate line. So we are definitely in bearish mode for sure across all these major indexes. Even with this, again, very typical Monday, right? For the past 5 weeks, right? We've been rallying the past 3 especially. Pretty good weeks, but the past 3 weeks have been bearish days every other day. So out of the 12 possible days, the majority of them have been bearish. So we need to kind of break that trend here this week. Hopefully, you don't have a lower low. You do have a lower close as of right now on the bearish chart. The PPO is falling. You have a negative candle that is flirting with getting back above its moving average. You get back above its moving average, things turn around. It might be brief. You can see this one was brief. You never did get above 0 there, and you were you had the red line. And then over here you had some, it got above the moving average and never did get above 0, and we turned lower. So, getting above 0, getting positive can really change things around for this. So let's keep our eyes on that on the weekly chart and see whether or not we end up with a lower low. Because the first sign of weakness is for the bearish, for the first sign of a reversal, I guess would be a better way of saying it, is you don't get the lower low or the higher high if you're bullish. You don't get the lower low, and then the next sign, which usually coincides with the transition candle, is you get a higher close. So let's keep our eyes on that and see whether or not the rest of this week gives us that. Again, I expect that this week won't be as bearish. I don't think it'll be too bullish either, but I don't think we'll have as bearish of a week as what we've seen. And we have 3 red arrows across the board, so we are in intermediate decline. MACD histograms are all rising. It's typical when you have a near-term increase, which is what I'm thinking that we're going to be getting here, and really nothing more than that. The S&P is still easily below its 8 and 17-day moving averages. They both have crossed the 30 already. In fact, they're both close to crossing below the 50. The 30 is still above the 50, but I think there's still a gap of volume all the way down to 420. There's still a gap to the 200-day moving average as well. that we have to fill in between the 50 and the 200. So I think, you know, the MACD is still below its moving average, is still negative. Stochastics and its moving average is well in the reversal zone. So I feel like we're still easily in bearish mode despite the short-term bullishness. Almost a repeat of last Monday's market forecast video. And we did get above 25 on the negative index, below 20 on the positive, though they both reversed. One day doesn't make a trend, of course. Looking at the RSI and the CCI, you can see you're back above this minus 150 mark, although you're still negative. If you look at the weekly version, we are negative there too. But remember, the trend doesn't change until the weekly one turns to minus 100. So that didn't happen on any of these other intermediate declines. It doesn't only happens when we're in correction mode, right? So it doesn't really happen during intermediate declines. So that's kind of something to keep an eye on as well. And the way to watch that is the daily chart to see if we get back above. You know, we've been below minus 100, which makes this a buying opportunity. And we've been below it a lot longer than the last couple of intermediate declines. So that's why I think we'll probably, and we've been below 40, so we're probably in the mode of more than just a little weak, shallow intermediate pullback like what we've gotten here recently. The Ichimoku cloud, the trend strength is the intermediate trend strength. Again, that's been the ceiling. For the last couple have been weak, but for an intermediate decline, the ceiling is for this intermediate trend strength on the declines, right? When you're in a bullish market. So we're in the cloud. Maybe if we really can hold this cloud over this next week and stay up here and get back maybe above the blue and the green and or blue lines, and you know the rate of change is going to stay negative for a while, but you know if we can get those back above, they're great. If not, then the longer we stay below those lines, the more likely we are to be more bearish, especially if we get below the cloud, especially if we stay below the cloud by the time it turns pink, right? If we get back above it by the time it turns pink, great, because the pink is it's usually this intermediate decline plotted forward by 26 days. This intermediate decline was so small, you only had a few days, but it's plotted forward. So here's our intermediate decline. It hasn't turned pink yet on the cloud. But once it does, it's plotted forward 26 days. So that gives us, quite a bit of time actually, over 5 weeks, almost 6 weeks to get us back above there. So that's kind of what we're going to be watching for. Again, I'm in the camp that we are in a more of a correction. That we're going to start with more of a correction, which means this pullback will be deeper than most pullbacks, most bullish. But it'll still be just a pullback, but it'll probably be a little deeper, especially when you have such a wide gap. Remember, pullbacks basically fill in the gap between the 50 and the 200. So when you have such wide gaps, the last time we had a pullback that started the correction, we got way below the 200-day moving average. We got down below it initially, tried to get back above it, but really got down below it before we failed in March. And then the correction really kicked in gear as we got below the 50-week moving average. So that's, your pullback typically gets you to the 200-day moving average. But especially with this scenario where it's probably a bigger gap than what we even saw then when this last correction started. Here, let's go 50 and 200 here. You can see we're up about 8% gap between those two. It is a bigger gap as you follow my cursor to the left than what we saw at the beginning of 2022. So that basically that just means we're going to have a very uncomfortable pullback if we were to fill in that gap, which is what I expect that we'll actually end up doing by the time it's all said and done on the pullback, right? On just the pullback alone. Looking at the Bollinger Bands and the Keltner channels, the bands, of course, are outside the Keltner channels. We finished Friday. We closed Thursday below the Keltner. We finished Friday back above it, and we're easily back above it now. The momentum is still negative and still getting bigger and still can get bigger, right? I mean, this isn't what we're seeing right now is not necessarily like, strong momentum. It is strong for kind of a bullish intermediate decline, but if you follow my cursor over to the left, it's not very strong when you're in a correction. It can get worse, especially, again, that was the original pullback. So if it does get worse, then we see, that we will be in a correction there. If you take a look at the intraday moves today, we had a higher high and a higher low, and we closed above yesterday's high or Friday's high. Great. We filled in the gap there from Friday morning. We filled it in by the close on Friday. We filled in this morning's gap. So everything so far is bullish, and you can see why it's so easy. And I think we might have another day or two where we rally up here just in the short term before we turn back down, because we have dropped so fast. We've gone the point of control is way at the top of the chart in the 4-week range. The value area is up in the upper half of the chart, and there's a lot of room that we can move up or down and not have a lot of short-term resistance or support. So we can really move pretty quickly, again, in the very short term, up or down here. So we might get another day or two. It might be intraday, so just kind of be prepared for that. The Arun indicator, of course, the green line's got to get, for us to get a reversal sign to the upside, the green line's got to hit 0. That's going to happen by the end of the week. The red line's got to drop below 70. So that means no new lows by the end of the week, essentially. If we can avoid that, which I don't think we will, but if we can avoid that, then we'll have a good sign that will bounce off of this, and it will be nothing but just a short, shallow, intermediate decline. Taking a look at today's volume and trading range, like last Monday. Last Monday was really, really light volume. Today it was back to being below average again, and the range was just barely above the average. It was pretty decent range last Monday too, but it was below the average. Today's range was a little bit more, but not very big. It's been smaller than what we've seen. Just a little bit above that average there. So, and we are back above 1%. I mean, essentially, this has to be the low point. This going into this expiration, we can't have more weakness if we're going to avoid more of an extended decline. We need to bounce back up by the end of the week and be bullish and be fine. And Jackson Hole, whatever ends up happening, whatever causes the movement, we need to rally into the close on Friday and get back to smaller ranges, get back to smaller volumes, and get that Arun, and that will really go a long ways to us bouncing off of this low up to new highs, which would get us a lot closer to those 4,800 highs, right? The pre-correction highs that a lot of people have been using as a target for for the end of last year for months, and then now for the end of this year, pretty much for the whole year. So that's kind of what has to happen for those targets to play out. If you look at the volatility, which again, typically an intermediate decline doesn't end until volatility is at least above 95%, which is the last couple. If you take a look here, the last couple intermediate declines finished with, this one in March, you got above 95% and almost got to 100. Of course, the one before that, you were above 100%, and that's more norm. In fact, it's actually you get above 105% has been the norm. But volatility has been really light. But the fact that we're not even above 95% means we're probably not done. This would be a very rare intermediate decline where volatility did not even get above 95%, much less above the 100, which is where it needs to, and the VIX did not get above its 200-day moving average. Right, it'd be a very rare decline if this ends up being it. As you can see, the last couple did easily get above the 200-day moving average. So that's why, one of the other reasons why I don't think we're anywhere near the end of this current run, despite again a fifth straight really pretty decent Monday open to the week. All right, if we take a look at what's driving a lot of this price action, let's go to the asset class comparison chart and look at today. Today alone, you'll see what really stands out here and big time, and that is the Qs, right? The Qs are up over 1.5%. EFA was up a little bit, not very much. Emerging markets were up too. They're benefiting from the weakness in the dollar, but look at yields, and commodities were down, which is a good thing for lately. It's been a pretty bullish trend, but the bonds are down big today, which is not common for the Qs to be rallying so much, with bonds themselves being down so much. If you take a look at bond TNX, and then we'll look at TLT. But the 10-year yield rose up to 4.35% at the high, ended up closing at 4.34%. So again, in the past, that's been associated with increased rate hike expectations. Of course, the Fed's not going to raise rates anytime soon. Like the inflation rate's got to rise up a lot faster on a year-over-year basis for that to happen. So they're not going to be raising rates anytime soon. So your 3-month yield, for example, is not moving at all. It's still right around this 5.44%, which is again between 5.25%, 5.5%. So the effective Fed funds is basically where the Fed's at right now. But what is moving and continues to move is like the 2-year yield and of course the 10-year yield. The 2-year yield now is back to 5%, right? We got up to 5% there. And what that's showing us, again, is not an increase in rate hike. Those are still very, yes, we've gone from 11 to 13, but those are still very low numbers. They haven't really moved in the past month. And there's, the odds of, and if they did raise, it would be in November, not September, because they've established the skipping a meeting pattern, which essentially means they're raising rates at 12.5 basis points at every meeting. By waiting and then going 25 at the next meeting, that's like doing 12.5 rate hikes, right? So that they've established that pattern, and you are up a little bit for that November, up to 42. Again, that's still pretty darn low, and it's not very much higher than where it was a month ago, since as yields have really rallied in the past month. So that's not really the issue. What the issue is, when is that first rate cut going to happen? And again, March has been the time that has been determined. The market had priced it in for March. The 2-year yield was down. We were looking at a March rate cut, high probability, and now you're looking at about 33% odds of a rate cut in March. Very, very low odds. We were at 56% a month ago. We were higher than that before. We had been easily in the 60s and 70%. That's down now, and you can see the number of hikes by the end of the year keep dropping too. We had, again, about a 95% chance of 4 rate cuts just about a month or so ago. Very high odds of 4 or more, and now you can see those odds to get 4 or more. You have essentially 1, 2, 3, 4. You're looking at about almost 40% odds, where it was only 5%. So those odds are dropping. The rate that when we get our first rate cut and how many we get, they're the ones that's dropping, and that's what's impacting here. And again, that's been the bullish narrative for so long, and that's kept the yield curve inverted. And as of right now, that yield curve is uninverting at a very slow pace, because that's when these yields rise. It's a very slow pace. But it puts pressure on equities. Every one of these little our intermediate runs have occurred when the inverted yield curve has risen, and that's continuing to be the case now as we move up towards this 50 basis point, which will most likely occur because the 10-year is going to keep moving up towards 4.5, and potentially up to 5%, which I wouldn't be surprised if that ultimately where it ends up going. Obviously, it's having a negative impact, especially on the weekly chart. When you look at the weekly version, TLT is so extremely bearish in the long term, and you can see and now we are now flirting. Again, the MACD is nowhere near that level, so this continues to be the washout for TLT. Even if we do hit slightly lower lows, the MACD will most likely form a divergent low point, a higher low, with a slightly lower low here, which will be really setting us up for a bullish move on bonds. So again, not common for stocks to be starting an expansionary period where we get back up to old highs and move beyond them. It's not common for that to happen with long-term bonds as extremely oversold. Usually that happens when bonds are extremely overbought. That's when stocks can really take off and start some good runs. And bonds fall as stocks do that. And that obviously is not the case right now. So we're in a much different environment. And again, if stocks and bonds do rally together, then that means we're still in a very heavily inflationary environment. Nobody wants that either. So we're kind of stuck between a rock and a hard place with where long-term bonds currently are, and more than likely that when they start to move higher, that will coincide with a drop in equity prices. You can see crude oil have made it above its 50-week moving average. Had a bad week last week, a little bit of a reversal, but nothing too major. Still above the 8-week moving average. The 8 and 17 week have crossed above, and we'll see. Again, if 10-year yield is going to rise, it's going to be because crude oil and commodity prices are also continuing their rise. It hasn't been so bad this month, right? July was such a bad month, and we see that those inflation levels are working their way through the system. There's July right there. There we go. So there's July right over here. Sorry, there we go. July. August has been a really we've had 2 consecutive bullish months here in June and July. We're back to having a down month after having all these down months previously. So if we can kind of reverse this July, that would go a long way to kind of slowing down this negative sentiment that's in the market right now from the idea that inflation may be resurging. And of course, that is the case, right? Inflation expectations continue to move higher. The nowcast for the Cleveland Fed on inflation is looking at that September release after Labor Day to be at 0.8%. Now, most likely won't be that high, but even if we're at 0.4, 0.5, that's a strong number that will lift the year-over-year CPI. Continue to lift it. It bounced up last month. That would continue to bounce, and then once we get the September expectations, we'll see if that continues to be the case. And again, weakness in commodities in August would go a long way towards things settling back down after this 2 months of increases. Let's take a look at how the sectors moved here today. So it won't be surprising when you saw the Qs up as much as they did. It won't be surprising to see who the big winners on the day were. Especially again, Nvidia was a big winner and Tesla was a big winner, and so you'll see that technology and discretionary were 2 big movers, right? Communication services also did pretty well, matching the market. Everything else, including your safe haven areas and energy, which has kind of been trading along with them, all lagging behind pretty significantly. Now, remember, this whole bout of weakness started on August the 1st, so a lot of this is simply just kind of oversold bounces in technology especially, and consumer discretionary to a degree. They were the 3 worst performing sectors at the open on Friday, so they've bounced back up a little bit off of these oversold levels in the very short term. Of course, your safe haven trades haven't been doing that great. Energy's been doing better. Healthcare has been doing really well, but staples and really even utilities is getting hammered because they're getting hammered with the rising yields and utilities in real estate. So really, your only safe haven has been healthcare and energy. Energy being hammered itself during most of this. It had such a good 2022 when everything was bearish. It's had such a bad year to date until recently. So you're getting an oversold technical bounce in energy previous to this, and now you're getting an oversold technical bounce now in these 3 areas. And I really don't think it's anything more than that, and that's kind of why I'm not too gung-ho on this movement being one that's like signaling that things are changing back to the upside. Same thing happened last Monday is the same thing I'm seeing here. Lots of dark pink shading in a red line. I still don't have the red line on communication services, but you are below the moving average. Same thing with financials. Energy is the only one that's still holding up with actually a bullish trend. And then healthcare, you can see, has got that bull tag there. That, as you can see, the bull tag is these yellow lines. Light pink. These were light pink, and yellow line is what signals the change, right? You go through the change from green to red with these yellow. And so you expect that will eventually be the case here with healthcare, and eventually probably with energy as well. But those 2 tend to be the ones that are holding up, and you can see the oversold bounces, especially in technology and discretionary, that were coming off of clusters. Not surprising that they'll bounce up as much as they are, but until we get some more like this, I wouldn't bank into it. In fact, you would look for these gaps more than likely to fill in than not. All right, so for our trade idea of the day, I want to take a look at FedEx, FDX. You can see we got a bull tag on FedEx, and it was one of the stocks that was down. Not too many today, but one of the stocks that was down today, down a full percentage point. Got the bull tag on Friday and followed through so far with some more weakness here today. Intermediate line is falling with some pretty bearish short-term sentiment. Again, we haven't seen a bull tag for a while, and the last one produced this last intermediate decline that was actually rather shallow. Wasn't that big of a decline there. You also see some weakness here as well on the weekly chart. We got the lower high and the lower close a couple weeks ago. It turned into a transition candle last week, and then now we're getting the bearish candle. You don't have the red arrow yet, but you can see the candle has gone bearish. It's been below its moving average, and now it's gone bearish as the PPO is starting to roll over itself. When you look at the 3 green arrow chart for FedEx, it has 3 red arrows now. Again, that's what generally happens. Your stochastics is down to pretty bearish levels. Your MACD is down there as well, especially when you look at it on this chart. You can see the stochastics is dropping pretty hard. MACD has almost gone negative. So it's not only been below its moving average and has been for a while as we've been converging. We diverged we went up so hard and so fast. We've been converging for so long that we set up this big gap in volume here with in between these big gaps and these moving averages. So it sets us up to fill those in and to fill this kind of gap in there. So that's kind of what I'm expecting. Your DMI, which had been so bullish, is not so bullish anymore, right? You're about to get a crossover there, and the ADX is falling. Your Ichimoku cloud, the trend strength indicators both dropped to 0. So, and you're below the blue line. So the mature strong trend you had is gone now. So we're done with that upside momentum. There might be some up days, right? But we're done with the momentum to the upside. You see that reflected as well on the CCI dropping all the way to minus 200. That's a big move. It doesn't happen during bearish moves typically. And you're below 50. Watch for that to drop below 40 or not on the RSI. So you're seeing some signs of weakness in that regard. The Keltner channels, the bandwidth is so low. You are in the lowest quartile of the bandwidth. It's well inside the Keltner channel. So we are springing, right, with that big move and the long convergence. We're kind of springing for a bigger move to the downside. But there's, again, we haven't really had the breakdown. So what I decided to do here is similar to what we've done here recently, is do a bear call spread. So sell the low 30s delta, buy the 270. That puts us at, this is what the trade ends up looking like. So you see that break even. That break even is essentially right above these old highs. So we'd essentially have to turn this ship right back around, nullify this breakdown, turn it right back around, get back above these old highs and get going again. In which case, we don't want to be in this trade. So I'd be willing in that case to lose up to $400. All right, so we'd have a little leeway there, but we're willing to lose. We're trying to make 408, so we'd be willing to lose 408 if it does that. Otherwise, if we can get it down to over a couple $100 of reward, especially by the end of this week, then we can use this capital for another trade in September still, because we're 25 days out. And that's, we've done that multiple times on previous market outlook trades. I think we've done like 3 of them now where we've done bear call spreads that have hit that 50% of maximum gain like already for this expiration. We freed up that capital for future to keep using that for more September trades, and we're looking for that same scenario to play out here. As its earnings, we can ride it all the way to September if we need to. Earnings is after September expiration date. As you can see, the volatility is higher for October than it is September, so we don't have to worry about the earnings there. So we'd be more than willing to ride that all the way to September again if we needed to. All right, that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.